Hey everybody, welcome back. Minor Ramos here with Matters of Eternity, and you have Francine over here with Walter's Asset Protection, and we're bringing you this short series on banking. If you didn't get a chance to watch the last video when we talked about what happened in 2008, some of the stuff, bailouts and, running into bail-ins. In this video, we want to talk about what happened in 2020, because remember, Dodd-Frank was instituted right around after the fallout of the 2008 issues. Now, I was having a conversation with Francine, and in 2020, something pretty significant happened. So let's discuss that. Go ahead.
So we were all very into everything else going on in 2020, right? That kept us very distracted. Now, meanwhile, in the background, the Federal Reserve, March 26th of 2020, the Federal Reserve removed all reserve requirements for all depository institutions. So what is the depository institution? That is all banks and all credit unions. So they no longer, so if you watch the previous video, you saw that if you put $100 in, they had to keep 10 in. Well, they removed that requirement. So the banks no longer had to keep any reserves. So they can sweep all of your money, not just 90%. Now, something else with the fractional Federal Reserve banking system that we didn't touch on before is that at the end of the day, at 4:30, typically, all banks have to report to the Federal Reserve what they have in deposits in the bank. Then they can loan 900%
Percent.
times that number.
Yeah.
And so they're not just loaning out what you have in deposits, they're loaning out all of the deposits together times 900%. So if they're making bad investments, it puts everybody in a really sticky situation. And we saw the results of that. We saw the results of that with Silicon Valley Bank and SVB. And Silicon Valley, I'm sorry, and Signature Bank. And so we saw what happened, right? There was the investors found out that they didn't really have things going well, and so they started pulling out their money, and so that created big problems for them. Yeah. And so the government did something they said they would never do again.
Right.
But why did they do it? Was it because people like us had the money in the bank? That's not why. So typically, or not typically, but here's who had their money in those banks. Mostly it was the technocrats and the venture capitalists.
Right.
And they require them so that they can move something forward that they plan to move forward.
The issue was that FDIC covered up to 250,000. Most of these depositors way over 250,000. So when they started taking their money out, I mean, it was a snowball, an avalanche of what was going on. So, and I want to go back to 2020. So fractional banking before that, 10% of it. So in 2020, they removed that. That means that they were able to lend 1,000% of all the deposits.
Right.
Now, where can people read? Because there's legislation, the CFPB, right? The Consumer Financial Protection Bureau. Most people don't know about them. They could go on there and they could look at all the stuff. That's where you get all your regulations, and there's got to be how many regulations? I think at least at 17 is what I think in my head right now of the different regulations, right? But now let's talk, because we do talk insurance. How is insurance different? Why can people have a little bit more confidence in putting their money in an insurance product? Because the reserve requirements for banks are very different than reserve requirements for insurance companies. So my understanding is, in an insurance product contract, there has to be at least $2 for every policy that is written. Totally different than fractional banking, right? Talk about, because people want to know, okay, so there's all this going on, but what's the solution? Well, we talk a lot about protecting your money through insurance contracts. Let's, what have you got about on that?
Well, and before touching on that, I'd like to go back to the 250,000 that the Federal Reserve insures,
Right.
because what does that mean? Does that mean that if the bank closes their doors, so what happens? So the bank closes their doors, they have 5 days to be bought by another bank, and that has happened before. And so if that doesn't happen, then if your money's in that bank, then you put in a claim with FDIC. They decide how long they get to pay you
Mhm.
and what those payments will be. So your obligations are your and not considered when they're making that decision. And so a lot of people don't know that. They think, oh, there's going to be they visualize a man in a suit writing them a check in front of the closed bank, but that's not the way it works. And so it could put people in a bind. That's the first thing. And so people do need to know that. And so with insurance companies, it's very different. So an insurance company has to have 3 times what they are expected to give out in claims that year in an account with the Federal Reserve. That's the first layer of protection. In addition to that, they have to have 3 reinsurance companies that have already agreed to take on those contracts before they can ever invest a dollar.
Mhm.
So that's why we have so many insurance companies that have been around so long. We
Mhm.
have some been around since 1850, 1898, and 1935. And why? Why can they weather all of these economic turbulent times? It's because of their reserve requirements, and those have not changed. They are still held to the highest form of regulation, and they are so closely monitored, so closely monitored. Anything they do, my goodness, it's like, oh, they drop their rating and then they have to work and they build it up. Now, one thing that I would like to mention, because I've had that question, why did such and such company their rating dropped? Well, in 2020, a lot of people, rather than dealing with all of the new things they had to deal with at work with COVID, they decided to retire.
Mhm.
They said, I'm done. I want to retire. And so what they did is a lot of them moved their 401ks and their retirement, their 403bs, their IRAs into personal private pension plans
Mhm.
with insurance companies. So because their ratios of their deposits that they have in the Federal Reserve and their ratios are so strictly watched and monitored. That is why they'll quickly, drop them in a rating, but then they're able to, because they want to do better and they've been around since forever, right? And so they know how to get themselves back in the right place that they need to be. And
Yeah.
so that will sometimes even throw them off. So, it's crazy because good, they're doing awesome, right? All these people are investing with them or putting their money there. And then their rating dropped because it threw their ratios off. But now they got it together and they brought them back up. But it just takes them time sometimes.
They know how to manage money. They know how
Mhm.
to protect capital. That is
Absolutely.
a known fact. So, all right, guys, listen. So we've covered a lot in this video. There's a couple more coming that we need to discuss. But if you didn't watch the one prior to this one, make sure you go back and just kind of follow the succession here. Minor and Francine here, and we'll come back to you guys again. Thanks for watching.